Daily Fiscal Pulse for the 14th of May, 2026. We're looking at Thursday's session here. Keep in mind these numbers are settled, not live, as we go through the data. Let's start with what's capturing market attention right now. Equities and market moves are the dominant theme driving traders today. You're seeing headlines about traders pricing in a Fed rate hike following the inflation surge, and that's clearly influencing price action across the board. Market narratives can shift quickly though. The actual flows tend to be a more reliable indicator of what's really happening. Turning to the fiscal side, we saw a net transfer of $8.8 billion printed, with tax receipts doing the heavy lifting at $7.4 billion. Nothing that jumps out as particularly unusual when you first look at it. The ES futures are telling a more optimistic story than the flows might suggest on their own. We closed the session at 7,421, and that's holding above the 20-day moving average sitting at 7,186. The broader range for the 20-day spans about 601 points. What's notable here is prices managing to hold steady despite the fiscal headwind working against it. Zoom out and the acceleration in flows becomes clear. Government spending over the last 5 days is averaging about $9.6 billion per day. When you stack that against the 20-day average of roughly $2.6 billion, you can see there's significantly more cash flowing through households and into the market system. The year-over-year figures tell the same story. We're sitting at $858.2 billion in fiscal year-to-date spending, which represents roughly a 25% decline compared to the same period in 2025. That's a substantial pullback in fiscal support, and it does have meaningful implications for overall liquidity conditions. From a positioning angle, the fiscal backdrop isn't really offering a clear directional advantage at the moment. Our conditions gauge is reading -2, but here's what the historical record shows us. We've encountered this type of environment repeatedly, and even with tighter liquidity, the S&P has still managed to average around plus 0.7% returns over the following month. Markets don't follow liquidity in a straight line. They often grind higher anyway. One thing worth flagging is margin debt, which is currently sitting at the 100th percentile. That's quite elevated. Historically, when we see readings at that level, they function more as a caution signal than a bullish indicator. Looking ahead at what could shift the dynamics. Treasury coupon interest payment window is coming up on the 15th of May, which will bring a large reserve add and has the potential to move short-term flows in a meaningful way. So right now there's no strong fiscal signal pointing in either direction. The scheduled flows we've got lined up will be what determines if that changes going forward. That's where things stand as we head into the next session.